Hello everyone, this is the Financial Wizard, and in this video I'm going to go over Federal Reserve data and what it means for the economy and what it can mean for the Federal Reserve and what actions they may take in the coming months. So just some background, we're going to go first through some economic conditions in the United States, and then we're going to look at the tools and policies the Federal Reserve uses, and then I'm going to show what I think is my monetary recommendation, what the Fed should do and what it probably will do in regards to its policies. So it's really important for the stock market and for the current state of the economy as a whole. So first looking at the U3 rate, which is the unemployment rate, which describes workers who cannot find a job at all. We can see this very big spike during the pandemic and the lockdown, all the way from about 3.5, 3.8, all the way jumping to a high of about 15% before settling down. It's current at around 6% currently. And then the U6 rate for unemployment gives a better description and more detailed depiction of what those unemployed workers are. So there includes discouraged, people who have less hours than they should, or people who have had to give it up in regards for something else like childcare because they're at home or whatever. But you can see that this also jumped very high, and so our before pandemic lows were at about 7%. Now we're currently just under 10, so about 9.9 as of the July data. And looking at the labor force participation, so the monthly labor force participation has gone down significantly as with the pandemic and lockdown. It's come back a little bit, so we're at about 61.5% for labor force participation, which is very low considering before pandemic it was about 63.5%. So we're still coming back on that, but the employment market is still very tough right now, so we'll see that probably come back. And then looking at job openings, this is just the JOLTS job opening report as of July data. We can see that there are a lot more jobs open now as the pandemic ends. Those shaded areas on the graphs are recessions. So we can see the 2020 recession had a massive drop in jobs that were available, whereas same with the last recession in 2008. But the difference is that the market has come back much faster for job openings than it did in 2008. And so we're looking for people to take those jobs, and they haven't taken them yet. And that's concerning because jobs are opening and they're paying and people aren't taking them. So it brings the question as to why they're not taking them. Is it a monetary problem or is it a psychological problem? And then the differences in the return to work rate. We can see how many people are claiming unemployment, while the stark difference between the unemployment claims and the amount of openings of jobs has not gone proportionate. So if there's 40% more jobs, there should be 40% less claims, but there's not. There's actually an increase between that. So there's about a difference of 65% right now, looking at the latest release in June, whereas the monthly claims are actually increasing. So from that, they're at about 22%. So that's a difference of about 80% between the two. And that's very high because these people should be taking the jobs and not going on unemployment, but there seems to be an issue that has yet to be solved within the labor market, and that's going to maintain a really important place in the Fed's policy changes or not. And then discrepancies between the U3 and U6, we can see that the U6 is a lot higher because it includes more workers who are discouraged or have fewer hours, whereas the U3 only includes people who are officially unemployed and don't have a job at all, whereas U6 does include people who may have a part-time job or just have fewer hours because of economic slowdown. Looking at the core CPI, the Consumer Price Index, we can see how it's really jumped in the last month, and that's partly due because of the lockdown and the negative, or not negative, but below the Fed's 2% target. So people are starting to make up for the lost time they had, and as such, many more items are being have higher prices and are going to cost more. So men and women labor force participation is another important factor to look at. So for men, it's dropped sharply, but it's started to come back. It's always been historically higher for men. For women, it's dropped as well, but it hasn't come back at the same rate. So it dropped from about 58% to now it's about 57%, whereas men, it's dropped from 68 to about and now it's about 68% for men. So that stark difference and and how fast they're returning to work is important to pay attention to. And then the core PCE, that's the core personal consumer expenditure index. So that's all things that consumers are spending money on, and it measures how much people are spending, and it really does a good job of keeping track of inflation. And we can see this negative dip during the lockdown and during the recession of 2020, and then we can see this sort of recovery and then huge spike in July in the summer, and that's making up for the negative inflation that we saw in the earlier months of the year of 2020. And while that is good, it should not be nearly that high, because the 2% target that the Fed has is going to be reached when those two average each other out. So if it's still high when they average out, then there's a real problem of runaway inflation, which is exactly what the Fed does not want. And then looking at average hourly earnings, we can see how more people are getting more money, and how how employers are trying to really get people back to work, and especially with the sharp jump in hourly wages right around the end of the recession, you can see that towards the end of the lockdown, they're having trouble finding people to take those jobs, and it would really be beneficial if people started taking them, because wages are going up, jobs are more open, yet people still aren't taking them. And then looking at the wealth inequality gap that has been generated by the pandemic, a lot of the people hurt in the pandemic are people who do not earn as much, whereas people who have not been hurt are people who have money in the stock market, which has done fantastic since the pandemic. So the wealth inequality has really started to rise, especially since the recession ended. It's gone higher than it's ever been before, about 32%. And then the employment cost index has also been rising along with, just cost of everything in general. The cost for employing people is starting to rise because they need to incentivize people to return to work, and the only way to do that is through higher wages. Consumer confidence has also taken a big drop since the pandemic. We can see this huge drop that's from about 100 to 70, and how the consumer is starting to get back to it, but they really need to be more confident and be able to spend more to try to get us back to where we were. Core retail sales percent monthly change, so we're seeing a lot of return on that. So retail sales are starting to go back up after that initial drop in the previous months, so that's good, and hopefully that will help boost the economy and get people back out there. New home sales is another important thing to focus on. So they have absolutely skyrocketed since the pandemic. There was a big drop during the recession, as you can see in the shaded area around 2020, but they have simply just jumped after that once people started moving out of cities and changing houses. So that, along with the low mortgage rates, people are eager to buy homes, and that is something that's really starting to overheat, is the housing market. And we'll see more of that with the price sales. So the price sales of homes has also spiked. So from the pandemic low of about 375,000, they're now about 430,000 average as of the latest release of data. So that's really putting a bubble on what the Federal Reserve can do in terms of cutting back on the mortgage-backed securities that they are adding with quantitative easing, and that's something we'll look at later. The 30-year fixed mortgage rate has also it's at a historic low right now, as there's just more liquidity, and so the banks can afford to offer more competitive rates, and so people are more eager to buy a house because it's cheaper, so why not buy a house? And that's what's causing a very big mortgage bubble. Core durable goods, it's a month-over-month change. We saw a sharp drop right around 2020 during the recession, and then a spike right back up, and sort of averaging out about 2% right now over the last 2 years. And so with that, we can see how more people are starting to buy from the United States, and how manufacturers are starting to open up again and really try to get back into it. Construction spending. So construction has been a huge boost through the pandemic as new homes are being built, people are refurbishing, people who have the extra money are spending the extra money because they couldn't spend it on vacations or luxury, so they're going to switch their spending to refurbishing a home, building something else. They have the money to do it, and it's one of the only industries that could stay open during the pandemic, so it's really risen and is continuing to rise, which may show that there is a bit of inflation happening, and it may be higher than we expect it to be. Imports, another important thing to look at. So they've really dropped in the pandemic. They've started to come back, but it's going to take a while for imports to even out with exports, even though they're higher. On the next one, we can see exports have just jumped so much higher than imports have, because people are starting to go online and buy offline, so that makes it more attractive to buy online. And then you can see the trade balance of payments has only risen since the pandemic as people buy more online, which comes from overseas. And then the manufacturing producer price index, that really shows how manufacturers are starting to get back into it as they look at materials to buy. So materials are starting to skyrocket because sharp drop, and now everyone wants to buy the manufacturing industry's goods, so the manufacturing industry needs to buy goods to make their goods. So everyone's trying to do that right now, and that's why we're seeing such a huge jump in the index right here, from about in 2020 during the recession, about 189 to about 211. And then the M1 money stock measures just how much liquidity there is. So we can see a massive jump during the recession, and how that's just continuing to rise. The M2 is also beginning to rise, not nearly as much as it did for M1, just as there's more money that is being transferred out due to the Fed implementing quantitative easing. And then the gross private domestic investment. So we can see how there's a lot more, or the gross private domestic investment has recovered from what it fell to, but it should be a little higher to make up for the lost time that they had. So we're looking forward to seeing that rise in the future. And then bank credit is another important thing to look at. It has absolutely skyrocketed since the recession, as the Fed has worked hard to try to make sure that banks have more money, and it's really shown with this huge jump in 2020. You can see how banks are starting to just really have more money to loan, and they're eager to do it. So they have more competitive rates, and they can do a lot more. The U.S. dollar has also risen significantly before QE. So you can see during the recession it started to rise, and then right as the Fed started to almost print more money, thus it started to fall because it was for simply more money in circulation. The federal government debt is also rising very fast as the government has passed many major bills, and looking forward in the future, there's a $3.5 trillion bill that is currently going through legislation. So we'll see how far that goes, but that could certainly add a bump to the federal government's already increasing debt. And then another important point to look at is the price of gas, because it's a very well-known commodity to the consumer, and it has fallen since the pandemic, but it has very much risen. And then looking at the total transportation index, we can also see how it's fallen and has just not recovered yet, as people are waiting for the all okay and for the Delta variant to go away. So people are trying to wait for that. It has not nearly recovered what we're looking for, and it's one of the most affected industries. Non-farm employment. So we can see by the millions this massive drop in 2020 recession, all the way down to about 110, and so that's sort of recovered to about 120, but we're looking at pre-pandemic at about 128 million. So we still have quite a ways to go before we get there. Household debt as service has really just decreased. We could see how all this household debt that people have has been paid off, which is good because the disposable income people had before, saved up from the pandemic and lost trips, lost concerts, whatever, has started to come into play to pay down debt. So people are paying off credit card bills, people are paying off, home equity lines, and that's really showed in this graph right here. And then just looking at the global price of all commodities, it's really skyrocketed since the pandemic, as every economy has been hurt. So naturally, during a recession, commodities tend to rise, and we've certainly seen that in this recession. If that continues to rise, then there's probably going to be fears of inflation, because if they can't control it, then people are going to go to commodities rather than currencies. And looking at GDP, we can see this very drastic drop to about 9%, negative 9% during the lockdown, and then this return to about 7% high, and now it's evening out about 3% as the coming months are reported. So the real GDP change, which does account for inflation, is about 9% drop here in the beginning of 2020, and then back up to about 7.8%, and then has accounted for a much bigger run up to about 3.5% in the last report. So the GDP Price Index, so this measures inflation within the GDP. So we can see that is also rising very fast in the latest months as inflation begins to rise. So that's reflected here. And then air revenue, passenger miles. So this is measure of the air industry, and we can really see how it's been hurt very badly, and passengers aren't nearly traveling as much as they used to because they have Zoom. So business has been hurt, and business flyers were one of the biggest ones of the air industry, and they're still all on Zoom. So it really hurts the air industry because people aren't flying as much, and the biggest sector of flyers is, of course, businessmen. So that is not coming back as fast. Consumers are flying, which is helping, as we can see in the last couple months, but we're going to need business people to travel in order to get us back to the pre-pandemic high of about 90 million miles. So we'll wait for that. Restaurants are the other major affected industry, and we can see that with this huge drop of retail sales by restaurants. So the massive drop in 2020, and then this massive jump back as people started to do takeout or dine back in, and then the massive skyrocket as people started to dine back in as the pandemic kind of ended, and the worries of Delta did not seem to affect the retail sales of restaurants in the past months as much as, say, travel. So looking at the stock market, we have a lot of, very high returns. Of course, all at record highs. S&P, Dow, Jones Index, the NASDAQ, all very high throughout this recession. A small dip through the 2020 recession, but nothing is stopping the markets from going higher. And then just looking at the Volatility Index, so of course there's massive uncertainty during the 2020 recession, but that came down sharply, and now it is about where it should be, between 10 or 20%. So people are more certain now. There's no major spikes, so of course we should watch out for one. As we can look in the past at 2008, it didn't just happen the once; it happened later in 2010. It happened again in the following year. So maybe we'll see another one of those happen soon. And then just looking at the corporate bond yield. So the bond yields are falling very fast because equities are just simply more attractive right now. And people don't want to be stuck in bonds when they can just have equities that are returning faster. U.S. population growth is also something to look at. It has fallen significantly and is something that we should take into account, as there might be a shock to the next generation or not.